What happens when one of the most accurate financial minds of the last half-century decides the game is no longer worth playing? Not because he's tired, and not because his performance slipped, but because he believes the financial system itself has reached a point where rational analysis is no longer capable of producing reliable results. That's the question the world was forced to confront on November 10, 2025, when Michael Burry, yes, the same man portrayed in The Big Short, the same man who diagnosed the 2008 housing catastrophe years before anyone else, officially shut down Cyan Asset Management and terminated its registration with the SEC. This wasn't the quiet exit of a retiring manager. This was a man who made billions by identifying structural cracks in the economy before they turned into earthquakes, now choosing to disappear from the public markets at a moment when stocks were reaching their highest valuations in history. If it feels symbolic, that's because it is. And if it feels like a warning, that's because it absolutely should. Weeks earlier, on October 27th, Burry wrote a final note to his investors, one that most people completely overlooked, but that will probably be studied in finance classes for decades. He said his estimation of value in securities is not now and has not been for some time in sync with the markets. If you read that quickly, it sounds like generic investor language. But coming from him, it should send a chill down the spine of anyone with money in the markets. The man who predicted the implosion of subprime mortgages is saying that current stock prices have escaped the gravity of reality itself, that the numbers no longer add up, that the underlying fundamentals and the prices investors are willing to pay for them now exist in two different universes. When someone with an ordinary track record says this, you can ignore it. But when someone who made one of the single greatest trades in financial history says markets no longer reflect reality, something is deeply, structurally wrong. If you want to understand just how alarming Burry's departure is, you only need to look at the final positions he disclosed before going dark. In his last 13F filing, covering the third quarter of 2025, he was holding an enormous amount of put options, bets that the price of a stock will fall. He wasn't nibbling at the edges or dabbling in macro hedges. He had accumulated a staggering $912 million in puts against Palantir, one of the technology world's most aggressively celebrated AI companies. And on top of that, he was holding another $186 million in put options against NVIDIA, the company powering the global AI infrastructure boom and the single hottest stock of the entire decade. These weren't short, dated gambles. These weren't one-quarter swings. These options stretched years into the future, extending into 2026 and 2027. You don't make commitments like that unless you believe with absolute clarity that something enormous is coming, and that its consequences will unfold slowly at first, then violently all at once. Burry didn't simply think these stocks were overpriced. He didn't simply believe AI enthusiasm had gone too far. He was making a claim so bold that it would be reckless coming from almost anyone else. He accused major tech companies, plural, of manipulating the timing of depreciation charges on their AI infrastructure, meaning he believes the profits they're reporting to investors today are artificially inflated by accounting tactics that stretch the life of expensive hardware far beyond what is realistic. In plain language, he's saying the earnings powering the AI boom are built on numbers that don't reflect economic reality, that companies are spending billions on high-cost chips and data centers, but reporting profits as if those assets magically last twice as long as they actually do. If that's true, if these earnings are even partially fabricated through creative accounting, then the entire valuation structure of the AI sector collapses instantly. So what does Burry do? He shuts down his fund, converts it into a private family office, and walks off the public stage. Once a fund converts to a family office, it no longer has to reveal its positions to regulators or the public. For the first time in years, Burry's investing strategy becomes invisible, and he chooses this moment, the very peak of the most explosive stock market boom in nearly a century, to go silent. His final message on social media before vanishing was cryptic but unmistakably deliberate. On to much better things. It was the timing, not the message, that unsettled people. Because this wasn't just any moment. The last time he shut down his fund while markets were surging was in 2007, just months before the global economy unraveled in a way few believed possible. To understand what Burry sees today, you have to understand the pattern he belongs to. Throughout American financial history, there have been a handful of investors whose understanding of market structure and human psychology allowed them to see around corners that others didn't even know existed. And each time one of these figures walked away from the markets, not during downturns but during euphoric peaks, a catastrophic collapse followed. Not sometimes, not occasionally, every time. In 1929, long before central banks built economic models or Wall Street analysts invented technical jargon, Jesse Livermore, arguably the first great American trader, noticed something odd. Prices kept rising, yet earnings stayed flat. Speculation replaced analysis. Ordinary people borrowed money to buy stocks with no understanding of what they owned. Livermore, who had made and lost fortunes by that point, recognized the signs of a market no longer governed by fundamentals. People laughed at him when he warned that stocks had become artificial and inevitably doomed. But on October 24, 1929, Black Thursday, the market buckled under its own inflated weight. Over the next 3 years, the Dow Jones fell nearly 90%. Livermore became one of the richest men in America by betting on the collapse. Millions who ignored the warning lost everything. 7 decades later, in March 2000, the same script played out. Silicon Valley was drunk on the promise of the internet, and investors believed traditional metrics like revenue and profits no longer mattered. Julian Robertson, the founder of Tiger Management and one of the most successful fund managers in history, looked at tech valuations and saw mathematical impossibility. He shut down his fund, not because he was losing money, but because he refused to participate in what he called an irrational mania divorced from reality. CNBC mocked him. Tech CEOs dismissed him as washed up. 1 month later, the Nasdaq peaked. Over the next 2 years, it crashed nearly 80%, wiping out trillions of dollars and destroying thousands of companies. Robertson was early, but he wasn't wrong. Reality came for the bubble anyway, and most investors learned the truth the hard way. Then came 2005 through 2008. While the world was partying on cheap mortgages and the illusion of endless home price appreciation, Burry sat alone in his office, reading mortgage bond prospectuses that even major banks didn't fully understand. He saw that the loans underwriting America's housing boom were ticking time bombs. He bought credit default swaps, bets that the mortgage bonds would fail, when almost no one else on earth believed they could. His investors rebelled. The media mocked him. Banks accused him of misunderstanding their products. But when the housing bubble finally burst, Burry's fund returned nearly 500% in a single year, and he shut it down shortly after. Not because he was wrong, but because the market itself was broken. Months later, Lehman Brothers collapsed, the financial system froze, and millions lost their homes. This is the pattern when the smartest players exit the field during a boom. They aren't quitting, they're escaping. And now, in 2025, Burry is stepping away for the second time. Not after a crash, not during panic, but at the peak of an AI-driven euphoria unlike anything the market has seen in decades. What makes this moment different, and far more dangerous, is that the bubble isn't contained to one sector. In 2000, it was internet startups. In 2008, it was real estate finance. Today, it's everything connected to the promise of artificial intelligence. The largest companies in the world, Apple, Microsoft, Amazon, Google, Meta, Tesla, and Nvidia, have grown so large that their combined market value exceeds the GDP of entire continents. Their dominance is so absolute that if you look at the average retirement portfolio, anywhere from 20% to 40% of the typical American savings is directly tied to the fate of these companies. In other words, ordinary people are now more exposed to a single narrative, AI will transform the world and produce endless profits than at any other moment in market history. But here's the truth most people don't know: AI companies are losing money. They burn extraordinary amounts of cash. They require immense capital expenditures. Data centers, chips, servers, energy, cooling, networking hardware that must be replaced far faster than most investors realize. The hardware depreciates quickly, and the technological arms race forces constant reinvestment. Yet the earnings reported to investors suggest profitability not only remains intact, but is improving. This is what caught Burry's attention. If depreciation schedules are being extended beyond reasonable lifespans, then earnings are being artificially inflated. And if earnings are inflated, then valuations based on those earnings are fiction. This is why Burry's bets matter. His $912 million put position against Palantir wasn't a measurement of one company's weakness. It was a bet against the sustainability of the broader AI narrative. Palantir trades at valuation multiples so extreme that they defy mathematical logic. A 300-to-1 price-to-earnings ratio means investors are paying 300 for every $1 of annual profit. That's not optimism. That's faith bordering on religious belief. And religious belief is the final stage of any bubble. NVIDIA, meanwhile, has become a symbol of the AI age. It is the backbone of machine learning infrastructure. It is the oxygen of the new economy. But its market cap has ballooned to more than $3 trillion, more than the entire stock markets of many countries combined. No company in history has ever grown this fast for this long without experiencing a brutal correction. And Burry's long-dated put options suggest he expects exactly that. But the real danger is what comes next. When a bubble is this large, it doesn't simply deflate. It ruptures. And when it ruptures, it takes everything with it. The Federal Reserve spent years holding interest rates artificially low, flooding the system with cheap money. That liquidity didn't create sustainable growth. It inflated asset prices to levels that no longer have any relationship to reality. When liquidity disappears, the bubble doesn't slowly fade. It snaps violently back to its fundamental value. Retail investors, as always, will be the last to understand what's happening. They will continue buying because prices keep rising. They will believe the hype because the narratives are comforting. They will trust financial influencers who tell them not to worry. They will trust corporate executives who promise unlimited growth. They will trust analysts who issue price targets based on sentiment, not numbers. And by the time they realize something is wrong, the smart money will already be gone. Because that is how it always happens. Every era has its moment of delusion. In the 1920s, it was the belief that industrial expansion would continue forever. In the late 1990s, it was the belief that the internet would erase traditional economic rules. In the mid-2000s, it was the belief that housing never falls. And today, it is the belief that artificial intelligence will produce infinite profitability without infinite costs. But markets are governed by math, not belief, and the math of 2025 is flashing red. Burry stepping away is not a footnote, it is the headline. His departure is the canary in the coal mine. A signal that the market has entered a phase where prices have detached so far from underlying value that the very concept of investing becomes impossible. When the greatest contrarians stop playing, it's because they know the next move is not to profit. It is to survive. That is why he walked away. Not because he lost faith in his analysis, but because his analysis revealed a system so distorted, so manipulated, so inflated by narrative and accounting tricks, that the rational move is not to fight it, but to get out before it collapses. The first time he did this, the global economy nearly imploded. Now he's doing it again. The only question that matters now is whether people will listen, or whether history will repeat the same tragic pattern, where the warnings of the few are drowned out by the enthusiasm of the many. Right before everything falls apart,